Okay, Screencast 3. So far we've seen the arguments for and against free trade. Screencast 3 is about the balance of payments, which is essentially about how countries account for and keep track of the trade that they do. So I want you to imagine that our country is here, which is easy to imagine because it is. But I also want you to imagine that there's a little guy with a little clipboard at the border of our country. And this little guy is keeping track of all the money that flows into our country and flows out of our country. That little piece of paper that he has on the clipboard is called the balance of payments. And what this guy's doing is keeping track of the trade between our country and other countries. What the balance of payments is the sum of all the transactions that take place between our residents and the residents of foreign nations. That's what the balance of payments is. Now, a balance of payments statement is that little clipboard. It shows all the payments a nation receives from foreign countries and all of the payments that we make to foreign countries as a result of trade. It tracks the flow of currencies into and out of the country. Now here are some definitions, and this screencast is mostly a memorization screencast. There's a few things that you simply have to memorize in order to do well on the AP exam. We're going to call it a credit whenever foreign currency flows into our country. And in the balance of payments statement on that little piece of paper, these are going to be given positive signs, meaning that we're gaining foreign currency. So for example, if we export wheat to Russia, we send them our wheat, but they pay us for it, and that payment flows into the country. That'll be a credit, a positive number on the balance of payments. A debit then is whenever currency flows out of our country, and it's given a minus sign, a negative sign. So for example, if some US investor buys a share of stock in a Brazilian company, he gets a stock certificate or she gets a stock certificate and pays for that stock certificate, sending it off to in this case, Brazil. That would be a debit, money leaving our country. Now the balance of payments statement, that little clipboard, is divided into three parts, three accounts. They're called the current account, the capital account, and the official reserves account. And you need to know what goes into each part. The current account records the flow of most things. First off, payments for goods and services, so most trade. Secondly, investment income. Any money that people make from investments like stocks, bonds, savings accounts, that kind of stuff. Now, we're not talking about the stocks and bonds themselves. We're talking about the money made from those, the income earned from those investments. Finally, any transfer payments. A transfer payment is a payment that someone makes just to be nice. So when the government makes transfer payments, things like welfare, unemployment compensation, or in this case, international aid, if the government were to just give some other country some money, that would be a transfer payment. But there are also private transfer payments. Oftentimes, Mexican workers, for example, will come and work in our country and then send their money back to their families in Mexico. That's a private transfer payment, and if that money's flowing out, we're going to keep track of that too in the current account. Now, the capital account I want you to think of is keeping track of assets. Now, that could be real assets, things like buildings, land, skyscrapers, that kind of stuff. Or they can be financial assets, things like stocks and bonds. So this is a little bit tricky. Stocks, bonds, other financial assets go in the capital account. The money made from them, the investment income, goes into the current account. Finally, and maybe most confusingly, the official reserves account. Now, the Federal Reserve and other central banks around the world hold quantities of foreign currencies that they call official reserves. When adding the current account and the capital account together, if the United States has sent more currency out of the country than the amount of currency that's come in, we call that a balance of payments deficit, essentially a net outflow of currency out of our country. When there's a balance of payments deficit, the Federal Reserve will credit the account so that it balances. On the other hand, if there's a balance of payments surplus, if more money is flowing into our country than is flowing out, the Fed would take that extra currency and put it into the official reserves account. So the official reserves account is kind of like a counterbalancing account that is used to make the balance of payments add up to zero. In other words, the money flowing into the country has to equal the money flowing out of the country. And if it doesn't, the official reserves account is used to make up whatever the difference will be. I'll show you an example of that in a bit. Alright, so this is a typical balance of payments statement. This is the actual one for the United States from 1999 because it was the simplest one I can come across. You'll notice at the top, the purple numbers, that's the current account. And that's keeping track of things like goods, services, again, investment income, and net transfers. So you can see for the United States, we exported $684 billion worth of goods in 1999. That was money coming in, given a positive number. We imported $1,030 billion worth of goods. So we bought that stuff from other countries and we sent that money out of the country. You could see the same information for services. You could see the same information for investment income and net transfers. So in 1999, the balance on the current account was negative $331 billion. As a result of these kind of transactions, we were sending out $331 billion more than was coming in. Now, if you look at the capital account, foreign purchases of assets in the United States, $760 billion. Foreigners bought $760 billion worth of assets, buildings, American stocks, American bonds, American land in 1999. We bought $438 billion worth of foreign assets in 1999. And you can see the balance on the capital account is a positive $322 billion. Foreigners were buying more of our assets than we were buying of their assets. Now, if you add up the balance on the current and the capital account, the brown number in the balance of payments statement, you'll see that as a net of that, $9 billion more was flowing out of the country than was flowing into the country. That's where the official reserves account comes in. That official reserves number is going to be whatever number it takes in order to make the balance of payments total out to zero. So what had to happen is that the Federal Reserve had to come up with a $9 billion extra dollars in currency in order to pay for all the goods and services and other things we were buying from other countries. You could also kind of see what the state of the world is in terms of trade for the United States. We like to buy other people's goods and services more than they like to buy our stuff. And the way that we're essentially paying for that is by selling off our assets. We sell off our buildings to buy cheap foreign sneakers. We sell off stocks and shares of our companies in order to buy cheap foreign goods. Alright, again, this is mostly a memorization thing. You need to memorize what goes in the capital account, what goes in the current account. You need to understand that the official reserves account is a counterbalancing account that's used to make the entire balance of payments sum to zero. You need to know that positive numbers indicate money flowing into the country and negative numbers indicate money flowing out of the country. And that is pretty much what you need to know about the balance of payments.
Ladies and gentlemen, the unthinkable has happened. Some sick, twisted individual has stolen every teacher's edition in this school.
What do we do?
Declare a snow day!
Does anyone know the multiplication table?
Please, don't panic. They can smell fear.